Welcome to our in-depth guide to dividend investing. This video will provide investors with the necessary information and strategies to select the appropriate dividend stocks. This guide is intended for both novice and experienced investors, as it will equip them with the necessary information to make sound investment decisions and construct a portfolio that produces dependable income. We invite you to join us as we delve into the realm of dividend investing, uncovering the secret to selecting the appropriate stocks for long-term success. Understanding dividend investing. What is dividend investing? The primary objective of dividend investing is to invest in stocks or other financial instruments that regularly distribute cash dividends to their shareholders. These dividends are cash payments made by profitable corporations to their shareholders as a form of compensation for their ownership of their shares. Dividend investors seek to create a steady source of income by investing in companies that have a track record of paying dividends and have demonstrated the financial stability to continue to do so in the future. Benefits of dividend investing? Dividends are a great way to generate passive income. When you invest in a dividend-paying stock or fund, you get regular cash distributions that can be used to supplement your income or reinvested for growth. Dividends can help you weather market volatility. Dividend companies are more stable and resilient in times of market downturns. Dividends can provide a steady income stream, even when stock prices are volatile. You can benefit from compounding returns. When you reinvest dividends, you get more dividends over time. This can help you build wealth over time. Dividends are a great way to protect against inflation because they have the potential to go up faster than inflation. Dividends are different from fixed income investments because you don't have to worry about a fixed interest rate. Instead, you can increase your dividend over time, which helps keep your money in better shape. What's the difference between dividend yield and dividend growth? Dividend yield is a measure of a company's current income relative to its share price. It looks at how much income a company is currently producing relative to its current share price. On the other hand, dividend growth is a measure of how much a company is likely to increase its dividend payments in the future. It looks at the company's history of increasing dividends and how likely it is that they will continue to do so in the future. Both of these metrics are important to consider when looking for a dividend-paying stock. While dividend yield looks at how much money a company is currently generating relative to its stock price, dividend growth looks at how likely a company is to increase its dividends over time. A balanced approach that looks at both of these metrics is often preferred. How to identify high-quality dividend stocks? High-quality companies provide stable growth, consistent income, lower risk, and greater trust in the companies you hold. By carefully choosing high-quality companies that have strong fundamentals, investors can create a portfolio that matches their financial objectives and provides a solid basis for long-term capital growth. What are the requirements of high-quality stock? Earnings stability is a measure of a company's ability to generate steady or increasing profits over time. Find companies with a history of stable or rising earnings that demonstrate their ability to overcome market pressures and maintain profitability. Cash flow is the amount of money a company actually makes. It's important for companies to have good cash flow because it helps them stay afloat and pay for things like investments and dividends. You should look at how much cash a company has coming in, out, and from financing activities. Debt levels are a key indicator of a company's financial health and ability to pay its bills. It's important to know how much debt a company has so you can figure out if they're in a good position to pay their bills. You should look at the key debt ratios like the DEQR and the interest coverage ratio to see how much debt they have. A company with a lower DEQR and lower interest expenses means they can afford to pay their bills and reduce their risk of financial ruin. What is a dividend champion? A dividend champion is an S&P 500 company that has consistently increased its dividend for at least 25 years in a row. Dividend champions are companies that have consistently increased the dividends, even during difficult economic times. Dividend champions have a track record of increasing the dividends for 25 years or more, demonstrating their financial strength and long-term viability. What is a dividend aristocrat? A dividend aristocrat is a company that increases its dividends at least 25 times in a row. Investing in dividend stocks requires thorough research to understand the company, its financial performance and dividend sustainability, growth prospects, risk management, and investment decisions. Investing in dividend stocks increases your chances of building a diversified portfolio that generates consistent income and long-term wealth. When conducting research on dividend stocks, there are several key sources of information that investors can utilize. Company financial statements, earnings reports, dividend history, analyst reports, investor relations websites, SEC filings, financial news platforms. It's important to note, however, that while these sources are useful, investors should think critically and cross-check information from many sources to make sure it's accurate and reliable. Additionally, talking to a financial advisor or doing some independent research can give you more insight and perspective when looking at dividend stocks. When it comes to investing, it's important to think about things like competitive advantage, trends in the industry, and management quality. Let's take a look at each of these factors. Competitive advantage. A competitive advantage is something a company has that makes it stand out from the competition. It could be something like exclusive technology, brand recognition, or economies of scale. It could also be something like better distribution networks or exclusive partnerships. If a company has a competitive advantage, it can help investors figure out if it can keep making money and make long-term investments. It's important to know what's going on in the industry so you can figure out what your company's growth potential is. You can look at things like the size of the market, how fast it's growing, new tech, changes in regulations, and what people want to buy. All of this can help you figure out how attractive it is to invest in that industry and what the risks are. If you can figure out which industries have good trends, you can pick companies that are in a good spot to take advantage of them. The quality and performance of your management team can make a huge difference in how successful your business is. To measure management quality, you need to look at their history, experience, how they make decisions, and if they're in line with shareholders' interests. Investors want managers who have strong leadership, have a clear vision of what the company wants to achieve, and have a track record of running successful businesses. Good management is essential for growth, risk management, and getting the most out of your shareholders. Dividend yield is an important indicator of a company's ability to generate income. It helps investors compare investment opportunities, analyze cash flow, assess dividend sustainability, and gain insight into market sentiment. However, dividend yield should not be the only factor to consider when making an investment decision. Dividend yield should be considered alongside other fundamental and quality factors. Income-seeking investors may be tempted by high dividend yields, but it's important to understand the risks associated with excessive dividend yields. Below are some of the key considerations that investors should keep in mind when considering an excessive dividend yield. Unsustainable dividend yields. Excessively high dividend yields can be a warning sign that the dividend is not sustainable. Companies may artificially inflate the dividend yield by keeping or increasing the dividend while their stock price is declining. This could be a sign that the company is in financial distress or that the dividend payout ratio is too high. Investors should look into the reasons why the dividend yield is high and whether the company is financially able to sustain it. Dividend cuts. When a company faces financial difficulties or unexpected events, it can be forced to cut or cease dividend payments. A high dividend yield may indicate that the market is pricing in the possibility of dividend cuts. It is important to assess the company's financial health, cash flow generation and profitability, as well as its debt levels. An in-depth analysis can reveal the sustainability of the dividend payments. Dividend yields that are too high can sometimes be a sign of a falling stock price, which can lead to an increase in share price volatility. It is important for investors to consider whether the high dividend yield is due to a temporary market correction, or a reflection of the company's underlying issues. It is also important to consider the long-term outlook of the company beyond the dividend yield. While high dividend yields can be attractive, investors should exercise caution and understand the risks associated with them. Doing proper research and analysis on the financial health of the company and the sustainability of dividends is essential for making sound investment decisions. Understanding the risks associated with overly high dividend yields can help protect your investment capital and make decisions that are in line with your financial goals. Dividend diversification is a wise way to diversify your portfolio. It helps you manage risk and maximize potential returns. Here are some of the reasons why diversification matters. Risk mitigation. Diversifying your portfolio means investing in companies that pay dividends across a variety of sectors and industries. This reduces the impact of individual companies and sector-specific risks on your portfolio by spreading your investment risk. Diversification also helps you protect yourself from adverse events that could affect a particular industry or sector. For instance, if an industry experiences a recession, other industries in your portfolio can offset losses. Growth opportunities. Diversification allows you to participate in growth opportunities across multiple sectors and industries. Some sectors are expected to grow quickly due to new trends or innovation, while others offer stable and consistent dividend growth. By diversifying your portfolio, you can benefit from the changing performance of various sectors over time. Dividend diversification is a wise approach to diversify your portfolio by diversifying across different industries, sectors, and geographies. It reduces risk, stabilizes income, and optimizes returns. By diversifying across different market segments, you can strengthen your portfolio's resilience and take advantage of growth opportunities while reducing exposure to individual companies and sector-specific risks. Investing in dividend stocks involves a combination of fundamental research, selection of high-quality stocks, and long-term planning. By adhering to these principles, investors can increase their chances of constructing a portfolio of stocks that offer dependable returns, potential capital growth, and support long-term objectives. Continuing your education, staying up to date on market developments, and getting professional advice when you need it. Continuous education, staying up to date on market developments and getting professional advice give you the tools and knowledge you need to succeed in dividend investing. These practices allow you to adjust to changing market environments, make informed choices, and improve your overall investment performance. Continuous learning and engagement with the community of dividend investors allows you to fine-tune your strategies, enhance your portfolio's performance, and help you reach your financial goals. Dividend investing is a great way to build wealth, generate income, and reach your long-term financial objectives. By understanding the fundamentals of dividend investing, doing thorough research, selecting quality stocks, and having a long-term outlook, you can prepare yourself for success in dividend investing. Continue your education, stay up to date on market news, and seek professional guidance when necessary. By staying on top of the latest market trends, you can adjust your strategies to fluctuating market conditions and make informed investment decisions. Now, it's time to get started. Set your financial goals, determine your risk tolerance level, and create a dividend investing strategy that matches your goals. Explore different sectors and industries and build a diversified portfolio. Track your investments on a regular basis, review your portfolio regularly, and make changes as needed. Dividend investing is not for the faint of heart. It takes time for compounding to do its magic. You need to stay focused on your long-term goals, be disciplined in your approach to investing, and stay on the path to financial freedom. So, what are you waiting for? Let's dive right in. Take control of your future and start investing in dividend stocks today. Knowledge is power, and it's time to start using it to your advantage. Dividend investing can help you achieve early retirement and live life to the fullest. Your financial success is right in front of you. Take the first step toward a brighter, more prosperous future by investing in dividend stocks. Don't miss out on any more great dividend investing videos on this channel. Share this video with your friends and family.